Bitcoin's journey, from Satoshi's vision to digital currency revolution. Bitcoin, a revolutionary digital currency also known as a cryptocurrency, was conceptualized in 2008 by an enigmatic individual or group under the pseudonym Satoshi Nakamoto. This groundbreaking concept transitioned into reality in 2009 with the release of its open-source software, marking the beginning of a new era in digital transactions. The foundational pillars of Bitcoin are characterized by several key features. Decentralization, where no single entity like a government or central bank has control. The innovative use of blockchain technology for secure and transparent record keeping. A limited supply capping at 21 million bitcoins. Mirroring the scarcity principle of precious metals, the mining process, involving complex computational tasks to generate new bitcoins and validate transactions, pseudonymity in transactions, offering a degree of privacy, and its capacity for facilitating digital transactions across borders. Additionally, Bitcoin is renowned for its price volatility. The advent of Bitcoin not only heralded a new form of currency but also introduced the versatile blockchain technology, paving the way for numerous other cryptocurrencies and applications extending far beyond the realm of digital currencies. Bitcoin is a digital currency, also known as a cryptocurrency, which was invented in 2008 by an unknown person or group of people using the pseudonym Satoshi Nakamoto. It started being used in 2009 when its implementation was released as open-source software. Key characteristics of Bitcoin include decentralization. Unlike traditional currencies, Bitcoin operates on a decentralized network of computers. This means it isn't controlled by a single entity like a government or central bank. Blockchain technology. Bitcoin transactions are recorded in a public ledger called the blockchain. This technology ensures transparency and security, as the blockchain is maintained by a network of computers, nodes, and is difficult to tamper with. Limited supply. The total number of bitcoins that can ever be created is capped at 21 million. This scarcity is an integral part of its design, intending to mimic the finite nature of resources like gold. Mining. Bitcoins are created through a process called mining, where powerful computers solve complex mathematical problems. When these problems are solved, miners are rewarded with bitcoins. This process also confirms transactions to the network and adds them to the blockchain. Pseudonymity. Users interact on the Bitcoin network with addresses, strings of letters and numbers. While transactions are transparent and traceable, the real-world identity of the users behind these addresses isn't inherently known. Digital transactions. Bitcoin enables the digital transfer of value. It can be used for a variety of transactions, from buying goods and services to transferring funds across borders. Volatility. Bitcoin's price is known for its high volatility, with its value capable of significant changes in a short period. Bitcoin has sparked the development of thousands of other cryptocurrencies and has introduced the concept of blockchain technology to the world, which has applications far beyond cryptocurrencies. Bitcoin's usefulness stems from several key characteristics that differentiate it from traditional fiat currencies and payment systems. These characteristics have led to its widespread attention and adoption in various sectors. Decentralization. Being decentralized, Bitcoin operates without a central authority. This decentralization reduces the risk of censorship, fraud, or third-party interference, making it appealing for users who seek an alternative to traditional centralized banking systems. Lower transaction costs. Bitcoin can offer lower transaction fees compared to traditional online payment mechanisms like credit cards or bank transfers, especially for international transactions. Security and immutability. The blockchain technology underlying Bitcoin provides a high level of security. Once a transaction is confirmed and added to the blockchain, it becomes nearly impossible to alter, providing a tamper-resistant record of transactions. Financial inclusion. Bitcoin offers financial services to individuals who are not served by traditional banking systems, especially in regions where access to banking is limited or non-existent. Borderless transactions. Bitcoin can be sent or received anywhere in the world, facilitating international trade without the need for currency conversions or reliance on local banking infrastructures. Transparency. All Bitcoin transactions are recorded on a public ledger, ensuring transparency in the movement of funds. This can be particularly useful for auditing and verifying transactions. Pseudonymity, while transactions are transparent, the identities of the parties involved are not necessarily known. This offers a level of privacy, though it's not completely anonymous. Control and sovereignty over your money. Users have full control over their Bitcoin without needing permission from any external authority. This is empowering for individuals who wish to have sovereignty over their assets. Innovative potential. Bitcoin has spurred a lot of innovation in financial services, leading to the development of new technologies and services, including smart contracts, decentralized finance, DeFi, and non-fungible tokens, NFTs. Hedge against inflation. Some view Bitcoin as a digital gold and a hedge against inflation, especially in countries experiencing high inflation rates. Its capped supply contrasts with fiat currencies that can be printed without limit. While Bitcoin offers these advantages, it's important to acknowledge its limitations and challenges, such as price volatility, scalability issues, and regulatory uncertainties. The usefulness of Bitcoin can vary greatly depending on individual needs, local regulations, and the economic context. Bitcoin operates on a blend of technological principles in a decentralized network to enable secure digital transactions. Here's an overview of how it works. Blockchain technology. At the heart of Bitcoin is the blockchain, a public ledger that records all transactions. The blockchain is a series of blocks, each containing a list of transactions. Once a block is filled with transactions, it is cryptographically sealed and linked to the previous block, creating a chain. Transactions. When someone wants to send bitcoins, they broadcast a transaction to the network. This transaction includes the sender's and recipient's Bitcoin addresses and the amount to be transferred. Digital signatures. To initiate a transaction, the sender uses their private key to digitally sign it, proving they own the bitcoins they're attempting to send. This private key is a secret number that allows bitcoins to be spent, while the public key is derived from the private key and acts like an account number. Mining and confirmation. Transactions are verified through a process called mining. Miners use powerful computers to solve complex mathematical puzzles that validate transactions and add them to the blockchain. This process secures the network and ensures the integrity of transaction data. Creating new blocks. Once a miner successfully solves the mathematical puzzle, a new block is formed and added to the blockchain. The transactions within this block are considered confirmed. The miner who solved the puzzle is rewarded with newly minted bitcoins, the block reward, and transaction fees. Decentralized network. The Bitcoin network is maintained by a decentralized network of nodes. These nodes validate transactions and blocks, ensuring no single entity controls or manipulates the blockchain. Supply limit. There is a cap on the total number of bitcoins that can be in circulation, 21 million. This limit is built into the code of Bitcoin and is expected to be reached around the year 2140. Proof of work. Bitcoin uses a proof-of-work system to create a consensus on the blockchain. This involves miners competing to solve the puzzles, which in turn secures the network but also requires significant computational power. Wallets. To use bitcoins, individuals need a Bitcoin wallet. Wallets store the digital credentials needed to access bitcoins from a specific address and allow users to send and receive bitcoins. Pseudonymity. Users interact on the Bitcoin network via addresses, which are alphanumeric strings derived from public keys. While these addresses are public, they do not directly reveal the identity of the users. Understanding how Bitcoin works helps in appreciating its design as a decentralized, secure, and transparent system for digital value transfer. However, it's important to be aware of its technological limitations, such as scalability challenges, and the environmental impact of mining activities. The creation and development of Bitcoin is a story that combines mystery, community effort, and a multitude of contributors from various fields. The most notable figures in the story of Bitcoin are Satoshi Nakamoto, the pseudonymous individual or group of people who invented Bitcoin. Nakamoto authored the Bitcoin white paper titled Bitcoin, a peer-to-peer electronic cash system, in 2008 and released the first Bitcoin software in 2009. Nakamoto was involved in the development of Bitcoin until late 2010, after which they ceased communication and their true identity remains unknown. Hal Finney, a renowned cryptographer and one of the earliest contributors to Bitcoin. Finney was the recipient of the first ever Bitcoin transaction sent by Satoshi Nakamoto. He was also known for his work on digital rights management, DRM, and as an early developer of the PGP, Pretty Good Privacy, cryptographic software. Nick Szabo, a computer scientist, legal scholar, and cryptographer known for his research in digital contracts and digital currency. Szabo developed a concept called BitGold, which is considered a precursor to Bitcoin. Although some have speculated that he might be Satoshi Nakamoto, Szabo has denied these claims. Gavin Andresen, he was a software developer who became the lead developer of the Bitcoin reference implementation, Bitcoin Core, after Satoshi Nakamoto stepped back in 2010. Andresen founded the Bitcoin Foundation in 2012 to support the development of Bitcoin. Roger Ver, an early investor in Bitcoin startups and a prominent supporter of Bitcoin and its technology. He has been a vocal advocate for the adoption of Bitcoin and was nicknamed Bitcoin Jesus for his active promotion of Bitcoin. Vladimir van der Laan, he is one of the current lead maintainers of Bitcoin Core, the reference client for the Bitcoin network. His role involves coordinating with other developers and managing releases of the Bitcoin software. There are many other developers, entrepreneurs, and enthusiasts who have contributed to the development and proliferation of Bitcoin, making it a community-driven project. The anonymity of Satoshi Nakamoto and the decentralized nature of Bitcoin's development make it a unique case in the history of technology and finance. Refuting the given information about Bitcoin requires addressing its key aspects with counterpoints or providing a broader context. Decentralization. While Bitcoin is decentralized in terms of not having a single controlling entity, this decentralization can be somewhat misleading. In practice, a small number of mining pools control a significant portion of the Bitcoin network's hash rate, which could potentially lead to centralization risks, such as the 51% attack where one entity gains control of more than half of the mining power. Blockchain technology. Although the blockchain offers transparency and security, it's not without its limitations. The transparency can be a double-edged sword, leading to privacy concerns. Moreover, the security of Bitcoin's blockchain, while robust, is not infallible, and there have been instances of security vulnerabilities and successful hacks in the broader cryptocurrency ecosystem. Limited supply. The scarcity of Bitcoin, capped at 21 million, is often touted as a benefit. However, this limited supply could potentially lead to deflationary pressures, where the value of Bitcoin increases, but economic activities slow down due to hoarding. Mining. The mining process is resource-intensive and has been criticized for its environmental impact, especially due to the high energy consumption of proof-of-work (POW) mining. There is also a growing concern about the electronic waste generated by obsolete mining hardware. Pseudonymity. While Bitcoin transactions offer pseudonymity, they are not entirely anonymous. With advanced blockchain analysis tools, it's often possible to trace transactions back to their source, potentially compromising privacy. Digital transactions. While Bitcoin can facilitate digital transactions, its scalability issues, manifested in slower transaction times and higher fees during peak usage, make it less efficient for small, everyday transactions compared to traditional electronic payment systems. Volatility. Bitcoin's price volatility can be a major drawback for its use as a stable store of value or a medium of exchange. This volatility can discourage its adoption for everyday transactions. Regulatory challenges. Bitcoin faces significant regulatory challenges across different countries. Its decentralized nature makes it difficult for governments to regulate or control, leading to potential legal uncertainties for users and businesses. Technological challenges. Bitcoin's technology, particularly its scalability and energy consumption in mining, poses significant challenges. Solutions like the Lightning Network aim to address these but are yet in their nascent stages. Economic impact and adoption. The real-world economic impact and adoption of Bitcoin are still limited compared to traditional currencies. Its use in everyday transactions is minimal, and it's largely seen as an investment or speculative asset rather than a currency. In summary, while Bitcoin introduces innovative concepts and technology, it is not without its drawbacks and challenges, which include potential centralization issues, environmental concerns, scalability limitations, regulatory uncertainties, and its overall impact and adoption in the global economy. In conclusion, Bitcoin represents a paradigm shift in the world of finance and technology, embodying a blend of innovation, decentralization, and potential challenges. As the first cryptocurrency, it has pioneered the use of blockchain technology, offering a decentralized, secure, and transparent medium for digital transactions. Its characteristics, including a capped supply, pseudonymity, and the potential for lower transaction costs, position it uniquely in the financial landscape. However, Bitcoin also faces hurdles such as scalability issues, environmental concerns due to mining, regulatory challenges, and significant price volatility. Despite these challenges, Bitcoin's influence extends beyond just a digital currency. It has spurred a wave of technological advancements and opened the door to new possibilities in digital finance and beyond. Its continued evolution and the response to its challenges will be crucial in shaping the future of cryptocurrencies and their role in the global economy.